Okay, check the answer to homework question. I had given one question of capital gain for homework. It was question number 2. Read. Mr. X purchased a property during 94-95 for 50,000. See, whenever property is purchased before 1/4/2001, we have to follow this rule. Which rule? This rule. Purchase before 1/4/2001, actual cost FMV, whichever is higher. Okay. So tell me in this question, what is 50,000 actual cost? 50,000 is actual cost and FMV is 2,70,000. Out of the two, you will take whichever is higher. Okay. And then the property was compulsorily acquired by government during 1819. Can you tell me what is 1819? Transfer date. Tell me what is the importance of transfer date in this chapter. First say it is very important because transfer date will decide three things. One, to decide short long, we measure from purchase date to transfer date. Then to do indexation, upar transfer, niche purchase. So there you need transfer date. And to decide whether to follow rule before budget or after budget, it depends upon transfer date. So tell me, this transfer date is before budget or after budget? Before. So we'll follow the old rule, and in old rule indexation is there. And after budget there is no indexation. Okay. And what is this 18 lakhs? Initial compensation. What is it? Initial compensation. This will come in FVOC. It is full value of consideration. See, when government takes away my property, what is my consideration? The compensation. Consideration means what you get in return. And what is the date of receipt? 8th July 24. What to do with this? This will not help us in indexation, etc. See, indexation is upar transfer, niche purchase. This is not transfer date, this is receipt date. In this year, we have to pay the tax. Because compulsory acquisition tax liability arises in year of receipt. So in this year, you will have to pay tax. And you know where to mention this year? In the top and the heading. When you write computation of capital gains, in the bracket you should write 24-25. See, the year when you have to pay the tax, it is just to be notified in the heading of the computation. But our working of indexation depends upon transfer date and purchase date. How do you do index? Upar transfer, niche purchase. So this date you have to just write at the top in the heading. Computation of capital gains for the previous year, 24-25. Then Mr. X filed a suit. Suit means case, court case, against government challenging the amount of compensation. And the court ordered for additional compensation. What is this additional compensation? Enhanced compensation. This will also come in FVOC in the second working. And here you can minus only one thing, legal expense. And this tax liability will arise when? This is received in 7th May 26, so taxable in 26-27. So that's why see in the question at the end what they have given. Calculate capital gains for two previous years, 24-25, 26-27. 1 year is for initial compensation, other year is for enhanced compensation. So check the answer. See the way I have presented the answer. Presentation also you check properly. Huh? Computation of capital gain. See I have written the section. See whenever you remember the section of the capital gain, you can write in the heading. And the year of tax also you should write in the heading. See two things you can write in the heading. Relevant section and the year of tax. So here the section is 45.5. Year is 24-25. And for the second working also 45.5. The year of tax is 26-27. Now check. Full value consideration. So initial compensation 18 lakhs. Then tell me why I have done indexation, because it's a long term and it's before budget. See, even if long term after budget indexation doesn't come, what is the budget date? 23rd July 24. But this is before budget. Indexation will happen. So see, Why I have done like this 1, 2, whichever is higher? Because the purchase was before 1/4/2001. So you have to do whichever is higher. And you should also put the amount in the box which you selected. Huh? Tell me index, what mistakes students do? They blindly write our latest index in the numerator. Our latest index is 363. Will you write blindly that, or you will check the transfer date? Check the transfer date. Here what is the transfer date? 1819. How do I know? Look here. In the question it was given 1819. Okay. So that year index you have to search. And what was the index for 1819? 280. And below year of purchase. Purchase was before 2001. So index is 100. So getting this is long-term capital gains. Then enhanced compensation, only legal expense will come. And see, if the first working is long, the second working is also long. The nature of both the gain remains the same. And why it is long? Because we already decided. See here. This is long term because the property was acquired in 94 and it was taken away by government in 1819. So it's a very old property long term. And once in the first working it is long term, the second working of enhanced compensation will also be long term. So this was a homework question. Okay, now let us continue. Look. Okay, now in section wise, see capital gains chapter, you know how it is, right? First we have to do the basics which we did. Look. This basics we have already done. Now we are in the flow of section wise study. And in section wise, how many sections we have done? See. We did 45.1, 45.1a, 45.2, 45.5. Next section is what? 45.5a. This is called joint development agreement. Section 45.5a is joint development agreement. See, in this example, you will understand everything. Huh? Look at the drawing. First, try to understand on your own. Because my drawing is self-explanatory. So, what do you feel in this drawing? See, Mr. X, he was having a land. And you know, the land was idle. It was empty land. He was not doing anything with the land. It was simply an idle land. A construction company approached Mr. X and they give him an offer that you give your land to us. We will construct a building. And when a building will be constructed, in the building, few flats, we will give it to you for free. Free means actually it's not free. Access provided is land. So in return of the land, builder will provide few flats. And see, just to assume, I have assumed what you know, the top floor. Can you see my building? In the building top floor, can you see 3 flats? These 3 flats builder has agreed to give to Mr. X. But first Mr. X has to give his land. Can you see what is this oval shape? This is a land which is currently an empty land. Builder will construct the building and after the building is constructed, 3 flats he has agreed to give to Mr. X. So this is called joint development agreement. See, when we construct a building, it's called a project is being developed. The word is development. See the word development. And why it is called joint? 2 people are joining the hands. Mr. X, who is the owner of the land, and builder who is going to construct. They are joining together. That's why it's called joint development agreement. They will say like this only, that we will jointly construct a building. You give your land, we will do the construction. Okay. Now see, in this case, usually you know what happens? What X will tell builder that building construction may take time. It may take 2-3 years. So till that time I will have to wait. So please give me some cash right now. So generally, you know, builder will give some monetary consideration also. Not a big amount or small amount. Because your main consideration is the 3 flats in the new building. That is the main thing which you are going to get for your land. But you know what X might be thinking? that building construction will take 2-3 years time. So till 2-3 years my land has gone, at least give me some amount. So generally in such agreements, builder will give some monetary amount also. Not such a big amount, but some nominal amount, say 20 lakhs, 50 lakhs, that much amount will be given right away. Immediately it will be given. And when the building is ready, the 3 flats will be allotted to him. So in short, what is Mr. X's consideration? Consideration, some amount which is getting right now only, plus 3 flats that he will get when the building is ready. Okay. And whenever these things happen in real life, there is a written agreement. You know why it is necessary to make a written agreement? Because how will builder get the security? See, actually, currently the land is in the name of X. X might have orally said, okay, you construct. But what if suddenly X will say, don't touch my land, it's my land. So builder also wants some security. So builder says you give it in writing. You make an agreement that I, Mr. X, give my land to the builder to construct. And these are the terms. That writing has to be done. Because then only builder will feel safe. Yes, now I am rightfully allowed to construct the building. Otherwise, if nothing is there in written, see, I am trying to justify the word agreement. Agreement has to be made in real life. Otherwise, imagine if you are the builder and if I just tell you orally, okay, you construct. Suddenly after 5-6 months I can come. What are you doing on my land? It's my land. It will create an obstacle. That's why builders prefer to be done everything in writing. So it will be done in writing where all the terms and conditions are written. And once that writing work is done, the land is transferred in the name of builder. The land is transferred. Now tell me, will this lead to capital gains? See, whenever I ask you the question, will capital gains arise or not? You have to check the conditions. What are the conditions? There must be capital asset plus there must be transfer. Then there will be capital gains. Or we say government has the basis to charge. So check the condition. Think from Mr. X's point of view. Does Mr. X have any capital asset? Yes, his land. His land is his capital asset. It is his property. Is it transferred? Yes. It is transferred in the name of the builder. So transfer has also taken place. So both the conditions are satisfied. Capital gains will arise. And capital gains is always for the transferor. And here who is the transferor of the land? X. So for X, capital gains will be generated. You know one thing, capital gains is always for transferors. The one who transfers generates the gain. So X will have a gain. Okay, now tell me, in which year this capital gain will be taxed? What will be the year of tax? Generally, what is the year of tax? Tell me. Year of tax is the year of transfer. Where did I explain this point? Section 45(1). Year of tax is the year of transfer, correct? So tell me here, what is the year of transfer? The year when I give my land to the builder. Correct or not? So in that year I should pay the tax as per the general rule. But this is an exception. Here I will not pay the tax in the year of transfer. Why? Because see, the year when I transferred the land, it was a vacant, empty land. The construction was not yet started. See, if I have to pay the tax, I have to pay the tax on what I am getting. I will get 3 flats. I have to pay the tax on the value of 3 flats. But until the 3 flats are constructed, how will I pay the tax? Although my land is transferred and I am promised that I will get 3 flats, but let the flats get constructed, because until the flats are constructed, they will not be given to me. And unless I receive the flat, how can I pay the tax? So that's why here what law says, although the tax is in the year of transfer, but here it is not possible to tax in the year of transfer, Because to tax, the capital gain should be determinable. And you cannot determine the capital gain in that year. Because in that year the land is simply empty. It was yours, you gave to builder. The construction has not yet started. So how will I pay the tax? So see here, the rule is what you know. Year of tax is the year of issue of CC. You know what is CC? In construction line, there is a certificate called certificate of completion. See, when this building will be constructed, the municipal authorities, every city has some municipal authority. That municipal authority will certify, okay, the building is ready, we certify. And then it is called CC is received. CC means certificate of completion. And only when you receive the CC, then only you will have to pay the tax. Because then only you will get your 3 flats. Correct? You know, our 4 exceptions was CCDJ. In CCDJ, what is J? Joint Development Agreement. So finally, all our 4 exceptions are over. So tell me the 4 exceptions together now. CCDJ, conversion of capital asset into stock in trade. Everywhere you tell me when is the transfer and when you have to pay the tax. In conversion of capital asset is stock in trade, year of conversion is a year of transfer. But tax doesn't come in the year of conversion. It will be the year when the stock in trade is sold. Then compulsory acquisition. When the property is compulsorily acquired by government, that is the year of transfer. But that year you don't have to pay the tax. You pay when you receive the compensation. Then destruction. The year when the property is destroyed, that is technically kind of transfer. But tax is when you receive the insurance claim. CCDJ, the year when you give your land to the builder, that is the year of transfer. But tax doesn't come in that year. Tax will come when the building is ready. When you get the CC of the building, certificate of completion. Okay. Yes. His doubt is what you know. Sir, although he will get the 3 flats afterwards when the building is ready, but at present he is getting some money. You know, I told you, generally in such agreements, builder will give him some money right now. But see, that some money is a negligible amount. And see, tax will not come in 2 installments. Tax will come in one shot. Because you cannot do capital gain computation in 2 parts. 2 parts means right now builder gave some money, for that you calculate, and when you get the 3 flats, that time again you calculate. So that will create a problem, because that kawwa and kawwi is common kawwa. It's a single cost of the land. So although right now the builder might have given some monetary consideration, but that is a negligible amount that you keep with you, but it will be taxed later together when you receive the CC. See, I'll show you how the computation will be done. See the format. Our calculation starts with full value consideration. So see what has come in FEOC. Monetary consideration which builder gave me initially. See, this monetary consideration actually you got at the beginning only. At the time when I handed over my land to the builder, that time only I got some money. Plus stamp duty value of his share. Why do I say this as his share? Because see, it's a jointly developed building. And the sharing is all the flats will belong to builder. Only 3 flats will belong to Mr. X. So we say, what is X's share? 3 flats. So see, I have written. See, 3 flats is just an example. Huh? It can be anything. It can be 10 flats also. It will be mentioned in the question. So see, monetary consideration plus stamp duty value of 3 flats. That combined figure will become my FEOC. What is FEOC? Full value of consideration. Okay. And then after that, less transfer expense, net consideration. After that, what you do? No, this is critical stage. If it is short term, you write kawwa. If it is long term, You write indexed cover provided it is before budget. If it is after budget, you write cover. Indexation not allowed. Okay. In short, now you have to check short term or long term. How to check? The life of the land means X. We have to see when did he purchase the land and when did he give it away to the builder. See, when the construction will be ready, you don't have to see the construction date. I want to measure the life of the land. So I will see purchase date of land, transfer date of land. That will determine the life of the land. Because don't forget, I am calculating capital gain for the land. Flats is my consideration. The gain is generated from my land. My land is giving me gain. So you should see the life of the land. And life of the land is purchase date of land up to the date when it was transferred to the builder. And if it is more than 2 years immovable property, land is the immovable property, before budget immovable property 2 years, and after budget it is every asset is 2 years. So it's 2 years. So if more than 2 years, then long term. Okay. So let's assume it was long term. So I will do indexed cost of acquisition and see how I have done the indexation. Cost into index upon index upar, transfer niche, purchase. And what is the cost? Cost of the land. See, cost we write of that which is transferred. Our land has gone. So I want to see what is the cost of the land. See, what I get in return, it will come in FEOC. What I have parted away, what I have given away, that's cost will come in, that asset's cost will come in cover. So cost of land, tell me what will be the year of transfer here? Builder, correct. See, although you will pay the tax when you receive the CC of the building, but that is for paying the tax. Tax will come when the building is ready. But indexation depends upon transfer date. And transfer date is the date when X gave his land to the builder by a written agreement that I hand over my land to you, you construct the building. That land transfer date will come in the numerator. And purchase is the year of purchase. See, all this is normal. Are you noticing from whenever I am changing the section, a new FEOC is coming in front of you. Like see, first was 45(1)(a) destruction. Insurance claim was FEOC. Then 45(2) conversion of capital asset and stock in trade. FMV on the date of conversion became the FEOC. Then compulsory acquisition, compensation became the FEOC. Now joint development agreement, the HDB of the 3 flats and monetary consideration became the FEOC. That is why I insisted when you are solving the sum, FEOC you write with red pen. Because that is the thing which is changing. This part, it is same in all the sections. Okay. Now tell me, just for my satisfaction, look at this data and answer. Assume X purchased the land in 1415 and he transferred the land to the builder in 1920 and the building CC was received in, what is CC? Certificate of completion. It was received in 24-25. So answer my few questions. Answer. How will you decide short long? Tell me the year. From 1415 to 1920. Okay. Then. Means it will be long term. Okay. From 1415 to 1920. Then. How will you do indexation? Cost into index upon index. Upar transfer, niche purchase. So which index will come upar in the numerator? 1920. And below niche in the denominator 1415. Perfect. In which year you have to pay the tax? 24-25. And where to write 24-25 in my answer? At the top in the heading. See, when you solve the sum, first you write computation of capital gains. There you will mention the section and there you will mention the year of tax. Okay. So this was 45(5)(a). Section is over. Then continue. Next in order is Let me highlight this. This is done. Next section is what? 46. Ready? This is on liquidation. Pay attention. Every concept is small, small, small. You will love it. Section 46 is starting. What is liquidation? Liquidation means the business is shut down. See, when companies shut down the business, when they discontinue, stop the business, dissolution, winding up, it's called liquidation. Now tell me what happens at the time of liquidation. Books are closed, but what is the actual process? First, all the assets are sold, then you pay the outside liabilities, and after you pay the outside liabilities, you give it to the shareholders. This sequence you know or not? Now, when company sells all the assets, that will give rise to capital gains. That I am not discussing now. Section 46 is discussing what you know. That after selling the asset, after paying the outside liabilities, when the money is given to shareholder, there is a capital gain for the shareholder. That is discussed in 46. See why I am making this clear, because the moment I start the section of liquidation, most of the students think what okay, liquidation, at the time of liquidation, company sells all the asset. That sir is discussing. That's nothing is there to discuss. Tell me on liquidation when company has to sell off all the asset. That is a normal capital gains. That computation is not to be specially taught in a special section. So first remove that from your mind, that I am not teaching capital gains of the assets sold at the time of liquidation. So what am I teaching? After the sale of asset, after paying off outside liabilities, when we give to shareholder, there is a capital gain for the shareholder. Think from a shareholder point of view and use your brain and tell me how a shareholder is making a gain, capital gain. You imagine I am a company. Feel you are a shareholder first. Feel this properly. Company sold the assets, paid the outside liability. Now company is giving to the shareholder. Every shareholder will get some amount. Okay. Now you think from your point of view, how you made the gain. I'll do one thing. I will provide you some data with figure. If you try, we can talk clearly. In short, what you have to try, how a shareholder has made a gain. In fact, you try to find out the amount of gain only. Okay, first before that, wait. Will capital gains arise for the shareholder? See, basically, I want to first convince that there will be capital gain for a shareholder. How to compute that I will keep it later. First, capital gain will be computed. You know why? Why? Look. See, you have understood, but still I want to convince as per the law. Tell me what is the rule for computing capital gains? These conditions should be fulfilled. So tell me from a shareholder's point of view, what is his capital asset? His shares. So if someone says, is there a capital asset? Yes, shareholder has shares. His shares are his property, his capital asset. Tell me on liquidation, is there any transfer? Technically, there is no sale. On liquidation, shareholder doesn't sell the shares. See, when you can sell the shares, when the company is going on, but the company is wound up. So sale will not happen. But look, there is something called relinquishment. You know what was the definition of transfer which I gave you? Sarak 2. Sarak 2. In Sarak, sale, exchange. What was R? Relinquishment. To relinquish means to give up, to sacrifice, to let go. And shareholder is doing that only. When a company is liquidated, a shareholder has to give up his shareholding rights. See, until now, he was showing his power. I am a shareholder of this company. I have got right to receive dividend. I have got right to attend the meetings. I am a shareholder. He was proudly saying. But now the company is shut down. So he has to give up his shareholding rights. That means it's relinquished. Relinquished means to sacrifice, to give up. Now he cannot show his power of a shareholder. What power he will show? The company itself is liquidated. So he has to give up and relinquish his rights. And relinquishment is also transfer. And see, for that giving up, company is giving his money also, na? See, when you give something, you are getting something in return also. What shareholder has to give? His shareholding rights. Now he is no more a shareholder, but for that he is getting money from the company on liquidation. In short, I am proving that both the conditions are satisfied. Government has the basis to charge the shareholder. Now, how shareholder will be charged? Now calculate capital gain with this data. See, assume there is a shareholder Mr. X. He is having 10% shares of this company and this company is liquidated. And assume liquidation has been done after 23rd July 24. So do one thing, do some working and find out. What do you have to find out? Capital gain. You know the format of capital gain? FEOC, transfer expense, kavva, kavvi, all that. Do. Liquidation is after 23rd July. Huh? Keep in mind. Okay, now look here. Look. Mr. X is 10% shareholder. He has got 6,000 shares which he purchased for 12,000. So tell me what is 12,000? Kavva, cost of acquisition. And he purchased way back in 2011-12. And liquidation is happening in 24-25. So the period of holding is more than 1 year. It is long term, okay. But although long term, we will not do the indexation because it is after budget. It is after 23rd July. And in the recent budget, they have stopped indexation, okay. Now, in every capital gain, first you want to know your consideration. Full value of consideration. Consideration means what are you getting in return? My shareholding rights are given away. But what I am getting in return? So tell me what is he getting in return? As a shareholder, you have got right in share capital reserves. This you studied in accounts. If you are a shareholder of a company, you have got right over equity capital reserves. So let me highlight this. Equity capital reserves. This belongs to the shareholder. But tell me, this 8 lakhs, does it entirely belong to Mr. X? Mr. X is 10% shareholder. So 8 lakhs, 10% is what? 80,000. So see, I have already written here. Company will give 80,000 to Mr. X, the shareholder. So for Mr. X, what is the consideration? 80,000. So look here, I have done the calculation. Full value of consideration will be 80,000. Consideration means something in return. So as a shareholder, I am getting in return 80,000. You understood 80,000? 8 lakhs is capital plus reserve and you are a 10% shareholder. And then let's transfer expense not there. And wait, this is by the way long term. Huh? So I will have to cancel this. So I will cancel short term capital gains. But although it is long term, I will not do indexation. So I will not write index kavva. I will not write index kavvi. I will just write plain kavva and kavvi. Why? Because it is after budget. Okay. And what is the cost of acquisition? 12,000. So this way the answer is 68,000. So you will feel it's a simple question. But this is wrong. See, for a simple thing, I will not take so much footage. Na? If it would have been really simple, we would have moved on fast. Here there is the climax. You think there is something wrong over here. What's wrong? It will be difficult for you to imagine what's wrong because there is one technical knowledge which I am giving you now. Look, tell me, how did you calculate 80,000? 10% of 8 lakhs means shareholder has got right to receive the capital and the reserves. And you know there is a rule. Whenever reserves are distributed to the shareholder, it is deemed as dividend. And dividend is EFOS. So it cannot come in capital gain. You know why I am talking about dividend? Do you know how the word dividend is derived? What is the spelling of dividend? DI, VI, DE and D means it is divide. So what is divided? Reserves. So whenever company's reserves are divided, so the word divided brings dividend. So this is a dividend. But entire 8 lakhs is not dividend. Dividend is division of reserves. How much is reserves? 2 lakhs. So when company gives 8 lakhs to the shareholder, 2 lakhs is called dividend. But for Mr. X, what is his right in reserves? Mr. X is a 10% shareholder. So in reserves, what is the 10%? 20,000. So look, out of 80,000, 20,000 is called, read what I have written, deemed dividend under section 222C, which is income from other sources, which comes in income from other sources. And balance will become your FVOC. You know what mistake you did? You took entire 80,000 in FVOC. But because out of 80,000, some portion is sent to EFOS. So how can it come to capital gain? Tell me why it is called deemed dividend. Because see, a layman will not call it as dividend. You know what a layman will think? What dividend? The company is closed now. The company is liquidated. See, general people, they think dividend means what? When a company is operating, it is going on every year, shareholders are given dividend on year to year basis. They view that only as dividend because their view is narrow. But law says, why do you have a narrow approach? Dividend is division of reserves. So whenever companies' reserves are divided, so whether it is at the time of liquidation or whether when the company is going on, whenever the reserves are divided, it is division of reserves means dividend. But people don't accept this as dividend. That's why law says deemed, assumed to be dividend. You don't agree, but we will assume this as dividend. And there is a section for this 222C. In deemed dividend, there are, look, 6 sections. How many? 6. 222A, 222B, 222C, 222D, 222E, 222F. Amongst these 6, one we have done. 222C. Okay, 222C we have done. Okay. Now tell me, if this is deemed dividend, so where will this 60,000 go? Face value. This is not face value. Full value of consideration. So see, this was wrong. So what is right? 60,000. So what is the correct answer? 60 minus 12, 48,000. Indexation was not done because it is after budget. Okay, now look here. Look. See, in the law, they have given a format only. Read this, please read this. Money and money value of other asset received by the shareholder should be divided into 2 parts. See, what did I do? I divided 80,000 into 2 parts. So how it is written in the law? Read and tell me. Money and money value of other asset. Tell me why it is written money value of other asset. Sometimes share See, I want you to understand the concept of how did he make profit of 48,000. See, look here. The face value of the shares is 60,000. Means his share, I am talking, his share. And why this is 12,000 then? Because see, in 2011-12, maybe from the stock market, maybe from the stock exchange, he might have purchased share for 2 rupees. See, 2 means 6,000 into 2, 12,000. And see, in stock market, sometimes the shares are available for 1 rupee also, 2 rupee, 3 rupee also. So, it is possible that he might have purchased from the stock market for 2 rupees only. So, based on 2 rupees, what is his cost? 12,000. But on liquidation, company's commitment is to give face value. See, even though you buy from the stock market for 1 rupee, 2 rupee, but when company has to give on liquidation, they promise you the face value. So that's why he made a gain. He was lucky that from the stock market he could get the share for 2 rupee. Understood why I am saying 2 rupees? 6,000 into 2 is 12. But when liquidation happened, company will not say, you purchase the shares for 2 rupee, I will give you 2 rupee. No, company has to give the face value to the shareholder. And based on face value, he is getting 60,000. That is how he is making gain. Okay. Actually, he is getting from reserves also. But the reserves which he is getting, that is deemed dividend. See, I was justifying that. Why did he make gain? Because he bought the share from stock market for 2 rupee. But on liquidation, company has given him face value. So the difference is his capital gains. Okay. Let me highlight what is done. Section 46 is done. Okay, now look here. Now I will take section 47. This I will do little later. Now see, section 47 and all 49 sections are interconnected. 47 and 49 sections are interconnected. Means unless we complete 47, 49 full, till that time you will feel it's still going on only, going on only. Only when this whole package is over, you will feel the sense of completion. Because 47 and 49, it's like a combo. It's like a combo, okay. But first I will have to teach 47, then I will teach 49. So see what is section 47. Read. Section 47 is exempt transfers. In section 47, there are 7 transactions where you will find there is a capital asset, there is a transfer, still capital gains is not taxed. See, generally what we have developed in our mind, if there is a capital asset plus if there is a transfer, government has the basis to charge you. It will be taxable. But there are few transactions where even if there is a capital asset, even if there is a transfer, even though government has the basis to charge you, but government will not charge you. It will be exempt. So here what will be the question in your mind? Why? Before why, what are such cases where even though the government has the basis to charge you, but government doesn't charge you? What are such transactions? And then why? So one by one I will explain. So see, first point is gift. So look at this example. Please look at me. You have to feel this example. Assume there is a land which I have gifted you. There is a land which I have gifted you. So in gift, check the conditions. Are these 2 conditions satisfied? I have gifted a land. So land is a capital asset. And when I gift you, there is change in ownership. And do you remember I said change in ownership means transfer? So the moment I gift my land, there is a change in ownership. So it's a transfer. So there should be capital gain. But this is exempt. Why? So see, I receive here 2 types of answer. Some students say, sir, it is income from other source, gift. See, gift is income from other source for the receiver. The one who receives the gift, for the receiver it is income from other source. So don't give me the reason that it is income from other source. I also know, I have taught you. Income from other source. I am Dr. LC, remember? But that gift becomes effort for the receiver. And capital gain is for the transferer. Do you know capital gains is for transferer? It is the seller who makes the gain. It's a transferer. So don't think from the receiver angle. So tell me, for the transferer, why no capital gains? Okay, now you will say, sir, I have not received any money. There is no consideration. So you know what law says? Even though you have not received consideration, we have the basis to charge you. Because see, you didn't charge the other party because you have love and affection. See, gift is a way to express your love and affection. So out of love and affection, I gifted my land. I gifted my land. But you know what government says? We don't have love and affection with anyone. We like money. We want tax. So if government wanted, government could have taxed me. You know on what basis? The land which you gifted, it had a market value of say 500 and you purchased at a cost of 100. So the land appreciated from 100 to 500. So on that difference you pay the tax. But now I will say, but I didn't charge anything. I gifted. You didn't charge because you have love and affection. We don't have love. We don't have affection. We want money. And we simply think one thing, that the land which you gifted, it is appreciated. You purchased the land for 100. Assume the cost was 100. And now on gifting date, the market value is 500. So with you, the land appreciated from 100 to 500. So there is a generation of gain. And if we want, we could have taxed you because we have the basis to charge. But still government is not taxing because government felt the person who gives the gift has no intention to make the gain. He is having no motive to make profit. And when someone has got no motive to make the profit, and there if we charge the tax, it sounds so cheap. It sounds so cheap. That's why law says, okay, we will let go, enjoy. But don't forget, you have to be grateful. We had the basis to charge because the conditions are being fulfilled. There was a land with you, you gifted, there's a transfer, and the land appreciated also. From 100 rupees, it became 500, although you didn't charge the other party because you have love, you have affection. But we could have taxed you on the difference. Which difference? 500 and 100. But we will let go because we understand the person who gifts has no intention to make gain. And when someone do not intend to gain, we also don't intend to tax. And you know why this has to be specified in the section? Because if this was not mentioned in the section, capital gain would have been taxed on this. Because as per law, conditions are fulfilled. And imagine if this section was not there, income tax department, the income tax officers would have tortured every assessee. You gave the gift, pay the tax. You gave the gift, pay the tax. Every gifter would have paid tax if this section was not there. And every income tax officer would have said what? You have love and affection. You gave free. We don't have love. We don't have affection. We will tax you. So this would have tortured the general public. That's why to protect the public, they have said, don't worry people. When you transfer the property in gift, we will not tax you, although we have the basis to tax you. Along with gift, there is one more thing. Will and inheritance. What is will and inheritance? When someone dies, the property passes on to someone. So imagine a father died, his property was passed on to his son. So here also if you see, conditions are fulfilled. Father had properties. So properties are capital asset. And when he dies, it passes on to son. Change in ownership. So there is a transfer. So technically here also condition is satisfied. But here there will be no capital gain. Because see, these are natural process. Sometimes naturally the condition gets satisfied. But that doesn't mean government will tax every time. That's why law says there are some cases in real life where conditions get fulfilled. Which conditions? Capital say transfer, but we understand you don't have the motive to make the gain. So don't worry, you be safe, we will not tax you. So even will and inheritance is actually attracting capital gain because the conditions are being fulfilled, but government will not tax you. Anyways, if capital gain should come here, capital gains comes on the transferor. The transferor has died. See, capital gains technically comes on whom? Transferor. And in will and inheritance, the transferor is the person who died. And government cannot catch the died person. Anyways, government doesn't even want the tax because there is no motive to make profit. Actually, see, when section 47 is going on, you should feel incomplete. 47 will give you the feeling of completion when 49 is also taught. See, right now, this section you will find, so what exam then? We want something which is taxable so that we can solve the sums. We are students, we like solving the sums. But here nothing is to solve. Tell me if a question comes on this, what will you say? No capital gain. So that's what I'm saying. 47 alone doesn't create importance in the student's life. Along with 47, when you study 49, it becomes a very good type of question, likely in exam. Okay. So till I come to 49, patiently just register these points as exempt. What is the next point? Hindu undivided family. Partition. And in partition, individual member is distributed the property. Do you know one thing? In the eyes of law, HUF is recognized as a separate entity. Even HUF has a bank account. HUF can do the business. You know HUF is a separate entity or not? Like see, even I have formed my HUF. See, once you have a family, like I have my wife, I have 2 children, so I have a family. So even I have created HUF. I have got one bank account in ICICI Bank, it is my bank account. And one bank account in Bank of Baroda, it is my HUF's account. And HUF is not a natural human being. But I have created HUF. How to create HUF, You simply have to open a bank account and apply for PAN number. Apply for PAN number, permanent account number. Once you open a bank, first you should have a family. You people cannot form HUF. You are alone, single, bachelor. But I have a family, so I can form HUF. And you know how did I form my HUF? I opened a bank account in Bank of Baroda. First I have to apply for PAN, First PAN number. And with that PAN number, I will create a bank account in Bank of Baroda. Means any bank you can do, but I did it in Bank of Baroda. Only 2 steps and HUF is ready. And HUF once it is formed, it can hold properties. Now, imagine HUF is holding crores of property. So who has got right over the property? Family members. Because HUF doesn't have a physical body. But HUF can own properties. So all the properties of HUF, who are the stakeholders? Family members. Like imagine in my HUF there is nothing. But imagine if my HUF is holding 50 crores property. But who is the legal owner? HUF. Now, if that HUF is partitioned, if there is a dispute between me and my wife and my children, we started fighting. Means we are 4 family members, we start fighting and we decided we don't want to live together. Wife you go alone, son you go alone, daughter you go alone, all separated. It happens in some families. See, we are lucky to have a good family, but in some family it can happen. So in such case, what will be the dispute now? What will happen to the properties in the name of HUF? Imagine my HUF, there is 50 crores property. And we decided I will live alone, wife you go there, son you go alone, daughter you also go alone. You have become a nuisance now, go. All are separated. So now when money matters will come, what will happen? HUF will be dissolved. HUF will be dissolved. And that 50 crores held by HUF will be equally distributed. So divide 50 crores by 4. 12.5 crores. So 12.5 crores I will get, 12.5 crores wife will get, 12.5 son, 12.5 daughter. So this way partition will happen. And many times the partition is done by giving away the physical property. Like HUF was having 5-6 lands. One land I took away. One land my wife took away. One land my son took away. One land my daughter took away. So here also the conditions are satisfied. Tell me how. There was capital assets worth 50 crores with my HUF. And now when there is a partition, when there is a dispute in the family, so HUF's property is transferred to individual member. Like didn't I say one land was given to me, one land was given to wife. So this way there is a transfer. Wait. Sorry. So there is a transfer or not? Change in ownership from HUF to individual member. So here also conditions are satisfied. And here also government has the basis to charge. But here government will not charge. Because there was no intention to make gain. Why did HUF give the land to me, to my wife and my son and my daughter? Because HUF, there was a dispute in the family. So it is but natural that the common properties are to be distributed to individual member. So it was a natural process. It's like when someone dies, property goes to his son. So HUF has become dead. See, HUF is Hindu, undivided family. But now we decided to divide. We will stay alone. So now it's like HUF has died. So when a person dies, the property goes to son. How it is exempt? Will inheritance. Similarly, in this example, HUF has died. And the property of HUF is passed on to individual member. So this is again without any intention to make gain. So no capital gain. Yes, if imagine it was a happy family. Huh? We are all together, united, undivided. And HUF sold one of the property to my wife. There was no partition. Happily living together. But one land was sold by HUF to wife. And if there is a sale, then capital gains will arise. See, in partition, there is no charging, no consideration. You take one land, you take one land, you take one land. It's just distribution of the property on partition. But that is on partition. If there is no partition, if the family is together, HUF has sold one land to member, then capital gain will come. In short, why I am trying to say this, it's not that whenever HUF gives, there is no capital gain. It is only at the time of partition, capital gains will not arise. But in happy situation, if there is a sale between HUF and member, then capital gains will arise. Then, next point. Have patience, unless we start 49, that main attraction will not come. Till that time, it might sound little boring. Okay, it's exam. Okay, but have patience. Next is next is point number 3. Look at this point now. Conversion of your personal property into common property of HUF. Now see, look, imagine. See, I will try to prove that the conditions are fulfilled, but there was no intention to make gain, that's why exempt. So see, imagine there is one person, Mr. X. He has got billions of property, crores, billion, he is a billionaire. Now he has become very old. He will die soon. And now Mr. X is worried about what? I've got crores of property and soon I will die in some year. And after my death, there will be dispute over the property. My wife, my children, they will keep fighting. Okay, and he doesn't want the dispute. And tell me, whenever a wealthy person doesn't want dispute after his death, generally he will make a will. Generally he will make a will. In the will, he will write that after my death, this bungalow should be given to my wife and this jewelry should be given to my daughter. People make a will. But you know what he did? He didn't make a will. While he was alive, he transferred everything in the name of HUF. Everything which was in his personal name, he registered in the name of HUF. Now even if he dies, no worry. Because now who has become the owner? HUF. And once HUF is the owner, the property will equally go to the family members. See, he was worried about what? There should not be any fight over the property. But when he transfers everything in the name of HUF, there will be no fighting. See, if the property remains in my name only, and if I die, then there is a dispute. But if I transfer everything to HUF, and HUF never dies, okay, unless there is a partition, but in general, HUF will not have a natural death, na? So I will transfer everything to HUF so that there is no dispute over the property. Now even if I die, I can die peacefully because the property of HUF will equally go to all family members. So this was his intention. But for this, what he had to do, his personal property he had to convert into common property of HUF. So there was capital asset and there is change in the ownership. How? The property which personally belonged to him, now it has become HUF's property. So there is change in ownership. So technically the conditions are satisfied. Government has the basis to charge. But government says, okay, we will not charge. Because why did Mr. X do all this? For family peace. To avoid dispute with the family, he did it. So there was no intention of making gain. Because no intention to make gain, government is exempting this, okay? So 3 points are done. Tell me this point in proper English. Conversion of self-acquired property or a personal property of an individual member into common property of HUF. So this was point number 3. Then point number 4, amalgamation. You know amalgamation? So look here. Assume X Limited has decided to shut down the business and transfer the whole business to Y Limited. And you know, the company which shuts down is called Amalgamating Company. It is called Amalgamating Company. And the new company who is taking over, is called Amalgamated Company. Ting and Ted. Ting and Ted. Ting means ting. The company which is gone. And the one who takes over is Ted. See, in exam they will write amalgamating company, amalgamated. So if you are not aware only of these words, it will go bouncer. Okay, now tell me, here the conditions are satisfied or not? Tell me why merger takes place, you know. Because you know what X and Y might have taught. See, you are separately struggling. I am also separately struggling. Let's join hands together. Let's join hands together. We'll do merger. And in merger, what was decided? X name will disappear. X's name will disappear. Everything will come in a common banner Y. Okay. So that's the reason of merger. But here, you know, these conditions are satisfied. Please check and tell me. Is there any capital? Yes, because when X Limited is taken over by Y, all the assets and liabilities will be transferred to Y. So there is capital asset and there is transfer also. Earlier X was the owner, now Y is the owner, there is a transfer. So here also the conditions are satisfied, but there is no capital gains. Why? See, this transaction looks like a transfer, but it is not a real transfer. You know, real transfer means what is mine is now belonging to someone else. But you know, in amalgamation, what happens? My property is still my property. My name disappeared. Everything has come in Y. See, imagine I am X Limited if I agree for the merger, what will happen? My properties will be my property only. But my name X Limited will vanish. It will come under a common banner Y Limited. But my things are still my things. See, transfer means when my property is now someone else's. But here it's not someone else's. My property is still my property. Like, see, for example, I am having my coaching class, Prime Vision. In Mumbai, my coaching class is by the name of Prime Vision. And for example, Prime Vision decides to merge with KS Academy. So you know what will happen? In Mumbai, my classroom, my camera, my projector, my benches, they will remain there only. It will all be mine. But in my classes currently there is a board, Prime Vision, that will be removed and a board of KS Academy will come. But what is the position of Shirish Vyas? What Shirish Vyas will do? My things are still my benches, my projector, my class, everything is mine. It is my name of Prime Vision will vanish and KS Academy will come. So this looks like a transfer, but actually it's not a transfer. Real transfer means when our thing becomes someone else's. But in the example of coaching class which I gave, my benches, my classrooms are still mine. It will be that same location only. Only the banner will change. So that's why law doesn't treat this as a real transfer. And since it is not since it is not a real transfer, government doesn't want to tax under capital gains. Yes, if it is like this, look, if Shirish Vyas sells the whole classroom to someone, I don't want to do coaching class business now. You take these benches, camera, projector, I am selling off. Then capital gain will come. Then all my properties will become someone else's. Then it's a pure sale. Owner will change. Then my benches and all are no more my benches. They are given away to someone. Then it's a pure sale. Then capital gain will arise. But when I go for a merger, my things will remain mine only. It is my Prime Vision brand will be removed and a new brand will come, KS Academy. So that's why this is not a real transfer. Then, yes, in amalgamation there is purchase consideration also. See, continue the same example. My class is in Mumbai, Prime Vision. Okay. So Prime Vision, if I agree to merge with KS Academy, so there will be purchase consideration. So what about that? But you know, in a real merger, purchase consideration will be, I will get shares. What did I say? My classroom, my projector, my camera, my benches will be mine only. But since there was a merger, what will happen? When my name Prime Vision is vanished, if the name of KS Academy comes, I will become a shareholder of KS Academy. Means I will be allotted shares. The purchase consideration will be in the form of shares. See, when I am saying my things are mine only, but what is the proof? I should get a shares for that. So KS Academy will issue me shares. So I will become a shareholder. And by becoming a shareholder, still I will say my property is still my property. Okay. So in such cases, purchase consideration is in the form of shares. If KS Academy says, Shirish Vyas, you get lost, you take money and go away, then capital gain will arise. You know, in amalgamation accounts also you have studied in the nature of purchase, in the nature of merger. And what government is exempting is in the nature of merger, where the PC is discharged fully in the form of shares. Means it should be such that KS Academy should give me the shares and I should remain still the owner of the class. Okay. But if they give me cash, that you are studying in accounts also. If the PC is in cash, then it is not a true merger. Then it is in the nature of purchase. Then capital gains will arise. Huh? Anyways, in short, no capital gains on amalgamation. Next point, holding subsidiary, you know. When there is a relation of holding and subsidiary, more than 50% shareholding, it becomes subsidiary. Okay. Now, Imagine if there is 100% shareholding relation between the two companies. So 100% means obviously I become the holding company. To become holding more than 50 is also sufficient. Here it is 100 and the other company is subsidiary. Now, if holding company sells some property to subsidiary, it looks like a sale. See here, imagine there was a sale of land. So land is a capital asset. Check the condition first. Land is a capital asset and there is transfer because holding company is a separate entity. If the land goes to subsidiary, it has gone to a separate entity. So change in ownership. In the eyes of law, there is change in ownership. So conditions are fulfilled. But still capital gains will not arise. Because this is not a real transfer. It looks like, oh, holding company's land is given to subsidiary. But subsidiary is not a third party. It is my company only. So when I give land to my subsidiary, I will feel the land is still mine. And if my thing is still mine, it's not a real transfer. Yes, the law will feel no, it was of holding, now it is of subsidiary, but I only know we are same. Especially when I am having 100% shares, we are just operating like a separate entity, but actually we are one and the same. So my giving of land to subsidiary is like the land is still with me. And when the property is still with me, it's not a real transfer. But it should be 100%. Huh? That means imagine if in the subsidiary company, I have got 70% holding. How much? 70% holding. And then when holding company gives the land to subsidiary company, then capital gains will arise. Because now holding company will feel the land has gone. It is with subsidiary. And in subsidiary, we are having only 70% stake. There is 30% minority interest. If I am holding 70%, the outsiders are called minority interest. So now I will feel my land is gone. Because I am 70% owner, but not 100%. Then I will feel the land is gone. Then capital gain will come and it will fully come. Not partly. Huh? Many students think, let it come partly, but no. If capital gains will come, it will come fully. If it is 100%, then it will not come. But if less than 100, say 90% also, then capital gains will arise. Because then I will feel my land is lost. It is with someone else only, because although 90%, it's not full ownership. Okay. So see, I have purposely written this in red because only when there is 100% shareholding, there is exemption. See, it can be vice versa also. Subsidiary selling the property to holding. So whether holding to subsidiary, subsidiary holding one and the same. If there is 100% relation, no capital gain. Because no actual change in ownership. In the eyes of law, they feel yes, owners have changed. But we know it is our thing only. Because subsidiary, although it's a separate entity, you know subsidiary is a separate entity, incorporated separately. But the real thing is, the insider thing is, it is my company only. So my property is mine. So there is no actual change in ownership. Okay. Try this one. Tell me, in amalgamation, what happens to a shareholder? For old shares, he will get the new shares. For example, look, Reliance is taken over by Infosys. So what will happen to the Reliance shareholder? Reliance shareholder, up till now they were holding Reliance shares, but it will be cancelled, they will get Infosys shares. And you know, even this transaction is satisfying the conditions. Which condition? Look, there must be capital asset, there must be transfer, there will be capital gains. Check the conditions. Think from a shareholder point of view. Shareholder was having Reliance shares. Take the example of Reliance taken over by Infosys. Huh? So shareholder was having Reliance shares. So there was capital asset. And Reliance shares are exchanged for Infosys shares. Exchange is a transfer. Exchange is a transfer. Read this. You know Sarak to, what was the full form of Sarak? Sale, exchange. So this is exchange only. When Reliance shareholder has to exchange Reliance shares for Infosys shares, there is an exchange. An exchange is a transfer. So see, what did I prove? There is a capital asset plus there is a transfer also. So there must be capital gains. But no capital gains in this case also. Why? Because shareholder did not have the intention to gain. You know what will that shareholder say? I didn't do it for gain. What to do? My company only got merged. So I had to exchange my Reliance share for Infosys. I didn't do purposefully. There was no intention in me to make the gain. So since shareholder didn't intend to gain, it was a company's decision to do the merger. So shareholder had to automatically exchange the share. He didn't plan to exchange the shares. That means, see, if you plan and do, like imagine, please pay attention, I am having L&T shares and there is no merger. Huh? There is no merger. And I tell my friend Hassan that do one thing, give your Wipro shares to me. Take my L&T shares, give your Wipro shares. We internally exchange. I remind you again, there is no merger. Huh? It is just I felt I am fed up of this L&T shares. I don't like L&T. I told my friend Hassan, you take my L&T shares and give your shares of Wipro Limited, Wipro. So this is a planned exchange. Now capital gains will come. How it will come, you know. The shares of L&T have gone. And the thing which has gone, the Kawwa will come, the cost will come in Kawwa. The cost of L&T shares will be Kawwa. And in return what I am getting? Wipro. What you get in return is consideration. You understand what is FEOC? Full value of consideration. So what is my consideration? Wipro shares. So Wipro shares market value will be my FEOC. And the L&T shares which are lost, the cost of that will be Kawwa. In short, capital gains will come because this was naturally happened or planned. Then government will say, oh, you are having so much of this thing to exchange the shares. Now you pay the tax. See, it was a natural merger. Like the example of Reliance. There I can say, I didn't want to exchange. What to do? These companies plan to merge. So it was a natural transfer. Then exempt. See, next point is similar. Try. You heard about convertible debentures? Convertible debenture get converted into shares after some years. So imagine when convertible debenture after some year got converted into shares. Are the conditions satisfied? Is there a capital asset? Is there transfer? Check and tell me. Convertible debentures are capital asset. And there is transfer because exchange. My debentures are gone. Now I have got shares. Debenture to share, exchange. See, exchange means what? One asset goes, other asset comes. So debenture gone, shares are coming, there is an exchange. Look here. Look at the drawing. Again, this amounts to exchange. And exchange is technically a transfer. So are you satisfied? Both the conditions are fulfilled. So capital gains should come. But even here capital gains will not come. Why? No intention to make gain. I didn't plan this. The nature of convertible debenture is such that after some year it automatically gets converted into shares. It was not my planned thing. It naturally happened. Because the debentures which are convertible have this peculiar feature. It has a peculiar feature that it will get converted into shares. So it was not planned, it naturally happened. So that's why no capital gains. Okay, now answer. Huh? If I was having some debentures and I was fed up of holding the debentures, I told my friend Hassan, you want my debenture? You take it, but give me your shares. Means I planned a transaction with Hassan. I told him you take my debentures and you give me your shares. Then capital gains will come. Then it's an exchange which naturally happened or it was planned by me. Then capital gain will come. How it will come? The debentures which are gone, the cost will come in Kawwa. And in return, I am getting shares. That will, market value of that will come in FEOC. Then capital gains will arise. But if convertible debenture automatically converts into shares and if it is done by the company only automatically, then capital gains will not arise. See here what I have written. No intention to gain. It was not planned. It naturally happened. See, can you see one thing on the screen? Look, etc. Means, in the law, there are few more exceptions. There are few more exceptions, or you can say exemptions. Exception means although there is condition satisfied, but still there is no tax. So this way there are few more points, but not relevant. These many points also why I am teaching, because it will connect with 49 section. It will connect with 49 section. And only those points which has got connection with 49, I have taken that many points only. Otherwise, if you see in the Bare Act, 47 is a big section. There are few more transactions and everywhere the logic is same. Huh? No intention to make gain, everything is same. But it is no point in wasting time over there. These many points are sufficient for you because our target is with the help of this we should be comfortably be able to do 49. And for 49 this much knowledge is sufficient. Okay. Actually 47 is not important. 49 is important. But section 49 cannot be taught without this much knowledge. Okay. So look here. 1, 2, 3, 4, 5, 6, 7. Tell me this 7 points list. How will you remember? See how I am remembering. Look here. Gift, will, inheritance, partition, conversion, amalgamation, shan. Repeat. Gift, will, inheritance, partition, conversion, amalgamation, shan. Then similar to amalgamation, holding subsidiary. And then exchange. Exchange. You have to remember like this only. Gift, will, inheritance, partition, conversion, amalgamation, shan. Then amalgamation's brother, holding subsidiary, exchange, etc. Okay. Now, after 47, we have to immediately take 49.1. Section 49.1, but this I will take after the break.